we've arrived at Module 3. This will consider our basic principles of financial analysis. For this, we'll hit Chapters 6 and 7. Let's do a quick overview of some key terms that we'll experience and use throughout this module. This slide and the next slide will divulge these key terms. First of all, balance statement. It's simply a document displaying the financial condition of a business at a single point in time. The basic definition is assets equals liabilities plus owner's equity. In your text, figure 6.1 on page 114 offers a sample of the balance sheet. An income statement, simply the document describing profit or loss earned by a business over a given length of time. The example of this or sample of this is found in figure 6.2, which is page 115 in your text. The statement of cash flows. This is the document providing information about how the cash position of a business has changed over a given period. Again, this you can find a sample of at figure 6.3 on page 117 and 118 in your text. Here are our next set of key terms, assets. And I know we talked about assets in Module 2. We'll hit this at greater length here in Module 3. Assets, as we talked about in Module 2, any resource or goods that might offer future benefits to a business and have value. We list them according to the length it takes to convert them to cash. We talked in Module 2 about liquid assets and hard assets. Liquidity then is that ease or quickness at which we can convert our assets to cash. Liability, we talked about this again in Module 2. We'll talk about it in greater lengths here in Module 3. Is any legal or financial obligation. It's listed on the balance sheet according to the length of time it takes to convert to cash. Let's dive into understanding assets a little further. Our most liquid assets are what we call current assets. They're the assets that can be converted to cash in 1 year or less. Some examples of these, while not all encompassing, this is a pretty good list. Cash, short-term financial assets, it's also accounts receivable, or money that is not yet collected from customers for goods that have been sold to them. Inventory that can be sold, and this inventory can be in raw materials, potential work in progress, or inventory that is the actual finished good. Also, current assets can be found in deferred income taxes and prepaid expenses. Fixed assets are the least liquid, or those assets that typically take a year or more to be converted into cash. Some examples of these are real estate, plant, and equipment. As we've looked a little more at assets, let's also go and look a little deeper into liabilities. Remember from our definition of our key term, liability are any legal or financial obligation an organization holds. Two ways to think about this: current liabilities or financial obligations in the now. Long-term liabilities are financial obligations of the future. So what are some current liabilities? Again, they must be paid in that year or less. A couple ways to think about it. There are accounts payable. There are bills that must be paid. It's compensation due to our players, coaches, and management for their yearly salaries. It also can be that yearly interest incurred on long-term debt, or it's additional accrued liabilities or expenses that are recorded, when they are incurred, but they have not been paid for. Long-term liabilities, again, are those future liabilities. You could think about them a year down the road. They won't be paid down completely for more than 1 year. These are players' compensations as well as coaches' compensations. 5-year, think long-term contracts. 5-year contracts. Next year and in 4 years down the road, you owe said player or coach the amount dictated on their contract. Also, long-term liability are shareholders' equity. This is the value of the stockholders' investment in the company. Long-term liability also could be deferred income taxes, or those taxes that were deferred or pushed back to be paid a year down the road. Let's talk about working capital. Capital is essentially equal to our assets minus our liabilities. When this number is positive, our organization expects that what we pay out over the next year is going to be less than the cash that will become available. An investment in working capital is an increase in net working capital between the 2 points in time on a balance sheet. This ultimately becomes really important. It gives us, as an organization, the ability to invest and reinvest. Earlier on in this module, we talked about one of our key terms being income statement. And that is, just as a reminder, the document that describes how much profit or loss was earned by a business over a given length of time. So let's break down those key concepts that apply to our income statement. First, revenue, it's that money coming in. Expenses, it's money going out. Expenses covers a lot of areas. We'll talk about that in a bit. Depreciation, we also talked about in Module 2, but we see it here on being used in our income statement. It's the cost of equipment and property used by the organization in the process of producing and distributing goods and services. Here are a couple more key terms we find in income statements. First is intangible assets. These are non-physical assets that provide value to the business. It can be such things as copyrights, trademarks, licenses, goodwill, and patents. Another key term we'll be talking about going forward is the cost of goods sold. These expenses are directly related to the production and distribution of goods and services. They sometimes are referred to as the cost of sales. These include such things as raw materials, labor, and manufacturing overhead. Selling cost in general and administrative costs have separate lines. We'll talk about that going forward. Let's look a little further into that income statement. The income statement describes how much profit or loss was earned by a business over a given length of time. It is equal to revenue minus losses. 3 parts of the income statement include, again, those revenue and expenses. We see that. There's also a non-operating section. That includes financing costs and any income earned by financial investments that the company has. It also needs to include taxes. The last part of the income statement is the net income. Please remember, as I referred to earlier, there is a sample of this in figure 6.2 or page 115 in your text. One of the key terms we talked about earlier was the statement of cash flow. So let's look at that a little more in depth. Just as a reminder, that statement of cash flow provides information about how the cash position of a business has changed over a period of time. It essentially measures cash flowing in and out of the business at that designated period of time. There are 3 primary sources of cash flow. 1, cash flow from and or used in operating activities. The cash flow from investing activities. And ultimately that cash flow from or used in financing activities. Please remember, as I stated earlier, figure 6.3 in your text on page 117 and 118 provides a sample of this important document. Now that we have a lot of this information, how do we use it to help us understand ways that we can make better decisions regarding the financial state of our business? Some ratios that help us better analyze the type of financial position our organization is in are these 5 ratios. They are financial ratios. It's liquidity, activity, financial leverage, profitability, and the value of the firm. These are all ways that we can determine the value of where we are financially at a given point in time. We are going to go over each of these 5 financial ratios in the upcoming slides. We know from previous discussion that liquidity is the ease and quickness with which assets can be converted to cash. Therefore, the liquidity ratio is or measures the ability of a business to meet those short-term financial obligations. How do we do this? Or what is this? It's a measure if the sale of the current assets will cover the liabilities. If that ratio is above 1, it indicates that the organization can sell assets to cover their liabilities. If that ratio is below 1, it indicates that the organization cannot cover their liabilities with their short-term sales. The acid test ratio is another way to think about liquidity. It's also known as the quick ratio. It examines whether a firm can pay its current liabilities without relying on the sale of inventories. This ratio gives us information about short term. Last, it is important to note that in making this connection, short term or the ease of quickness deals immediately with assets and liabilities in the short term. The second way to consider the financial state of an organization is through the activity ratio. The activity ratio measures how effectively a firm manages its assets. And remember, assets are those goods and resources. Two ways to do this. First is total asset turnover ratio. It's how effectively the firm uses its assets, those goods and resources, to generate sales. Second, inventory turnover ratio. This is how many times during the year the inventory is purchased and sold. We ultimately should recognize the better these ratios, that means the organization or company is typically more effective and efficient. The poorer these ratios determines that the company is ineffective in using its goods and resources to increase sales, and ultimately that company is or organization is ineffectively turning over its inventory. The third type of financial ratio we are going to consider are financial leverage ratios. These types of ratios have both a positive and a negative aspect. So a financial leverage ratio is one that measures the extent to which the business relies on debt, or we're going to think about that as the negative ratio, rather than equity, or the positive ratio, for financing. High ratios equal greater chance of bankruptcy or distress. So the positive way to look at this, the negative way to look at a financial leverage ratio would be a debt ratio. This considers a business's leverage from the standpoint of assets. That is, are their debts greater than their assets? That debt equity ratio considers a business leverage from the standpoint of the owner's equity. Remember, an organization or company that uses its own money or equity to leverage or to increase its business has a strong or a positive financial ratio. A company, on the other hand, that is leveraged in debt would consider this to be a negative or a negative ratio. The fourth financial ratio we're going to consider are profitability ratios. This essentially, as the name says, measures the extent to which a business is profitable. There are a couple of ways that we can determine profit or value of a company. The first is our return on assets. It's also known as a return on investment. This reflects the amount of profits earned on the investments in all assets of the firm. It measures the profitability on investment by all providers of funds. It's essentially the equation to accomplish the return on assets is the ROA is equal to our net income divided by our average total assets. Another way to determine profitability is our return on equity, or ROE. This measures profitability on investment by our stockholders. The ROE is equal to our net income divided by our average stockholders' equity. Next slide, we'll talk some more about other profitability ratios. This slide also continues to look at profitability ratios. The interesting thing here is that this slide considers the bottom line. And the bottom line for companies is their ability to generate sufficient earnings to continue growth and reward stakeholders. There are three ways to look at that bottom line. The first is our net profit margin. That is our net income divided by our revenues, and then also our gross profit margin, which is our gross income divided by our revenues. Remember, our net is essentially after taxes or deductions, and our gross is that before taxes and or deductions. I like to remember net as what is caught in the net after the taxes. That's my way to help think about and remember the difference then between those terms. The last bottom line concept is return on investment capital. This analyzes performance via those long-term investments that fund growth. Remember, profit is typically determined in that short-term range, but that return on investment capital would give us our bottom line, but would look at it more in a longer term or longer than 1 year range. The fifth and final financial ratio we are going to look at is the value of the firm. In order to do that, I want to talk about some key terms that we use in determining value. This slide and the next couple of slides will address some of these key terms. First of all, market value of the firm. We think of this as kind of that street value. That is, what are the stock buyers and the sellers establishing when they buy and sell shares in the business? It's the market value. Book value is the historic cost of assets minus accumulated depreciation. This does not necessarily represent true replacement value of an estimate, though. What is the owner's equity? That is calculated by adding retained earnings and the value of the common stock. This calculation is also known as net worth. Here are some other ways we can determine value of a firm. There's the book value per share. That is essentially the amount of the firm's value an annual stockholder has. We also have annual return or per share. It's that increase or decrease in value plus the dividends. It's that which is being returned. The annual rate of return is annual return divided by our initial investment. Our last three concepts in determining value are the dividend payout ratio. This is the dividends per share divided by our earnings per share. We also have earnings per share, which gets us at that net income divided by our average number of shares outstanding. And finally, our price earnings ratio. We also call this the PE ratio. It's our price per share divided by earnings per share. So what does this tell us? We've gone through roughly 9 terms or concepts in determining value. And depending upon our position in the company, as well as our investment in the company, there are different ways to determine the value or return on that company or investment. I want to move on now and talk about the value of money. And this is important for organizations to understand, as it helps make the company or organization more or less profitable. So how much is money worth? This notion is the value of the dollar one receives today is worth more than the value of the dollar one receives in the future. Why? Ultimately because the dollar received today could be invested, could be turned into increased profit, and that value then that is deferred or received in the future does not have that time from now until then to increase the value. So it's also this notion of the time value of money. It represents the concept that the value of money in today's dollars decrease in value the further out into the future it is expected to be received. In terms of time frame, there are 2 ways to think about our value of money. Future value, or how much it's worth in the future, and present value, how much it is worth right now at this point in time. So future value is the value of an initial lump sum of money after it's invested over a period of time or periods of time. It is the opposite of present value. Present value is the here and now. How much is your money worth here and now? And how do we calculate that? It's present value, and that is equal to the cash flow received at the end of the year divided by 1 plus our appropriate interest rate. We'll talk a little more in just a second about what this means. This slide shows us ways that we can calculate our future value. Formula indicates the future value is equal to our initial cash investment times 1 plus R, and R is our interest rate, to the T power, or the number of years which the cash is invested. Please note that table A.1 in your appendix A represents future values of $1 at the end of that time period, which means a variable number of time into the future over which the $1 is earning interest. So to use the table, you essentially locate the appropriate interest rate or return, and then the appropriate number of periods or years on the vertical axis. So let's do an example. If you as a sport organization started out with $500 and you invested that $500 and earned an annual 8% return, and in 2 years then your $500 would now be valued at $583.20. Therefore, your $500 in 2 years is now worth $583. Okay, let's think about present value of money. And sadly, to think about present value of money, we really need to think about the future value of money. Because that is, if I take my $10 that I have, what is its present value today? Well, it's actually less than that, because if I took that $10 I have today and invested it, it would be more in the future. So how do we calculate this? Present value is equal to present value times 1 plus R, or again, that annual rate of return, to the T number of years. And that ultimately equals our future value. Okay, so let's look at our example. Assume that Swish James, the best shooter on the team, has signed a contract including $2 million in deferred compensation that will be paid at the end of 2 years. So Swish James's contract states he will get paid now, and then at the end of 2 years, he'll be paid $2 million, and we'll call it a bonus. Therefore, what is the present value of this contract if he could earn a 4% annual return on his money? So in order to do so, we have our present value times 1.04, or that 1 plus our return, or our percent, to 2-year yield. And we want to know what it would equal for that $2 million. We then determine that the present value of our $2 million is actually $1.8 million, because again, think about that concept. If I got that $2 million right now, I could turn around and invest it. So the reality is, right now, my $2 million is only $1.8 million, because the present value of my $1.8 million could be turned into $2 million future value. Our next concept to think about in determining our value of money is a discount rate. Discount rate is the interest rate, or that percentage return that can be earned on an initial amount or initial investment. Discount rate is equal to the variable, or R, or that rate, in our present value equation. Think back to our previous slide. So for example, if a 5% annual return on a 1-year CD would yield $102,500, then a payment of $102,500 earned in 1 year is valued today at $97,000. Because remember, that discount rate, or rate of return, or yield, is that 5%. That's the difference we would get from our $97,000 today if that money was placed in a 1-year CD at a 5% return, would then become in 1 year that $102,500. And in this slide, we're going to consider compounding as a way to value our money. And I have now officially become my father, as I remember distinctly my father discussing the ills of getting a credit card because of compound interest, or the positive of putting my money in savings because of compounding interest. So here we go. I am my father. Compounding. It's the process of holding the stock or accruing a further return over the second year. And then what is compound interest? On the negative side, many loans, interest is added to that principal over the loan's life. Each payment of interest or return that is invested also earns a return. So on the good note, if I have interest, if I'm saving money and have received interest, that interest also then gets a return. It compounds. So here we go. Credit cards. If you borrowed $100 on your credit card at 10% interest compounded annually, you would owe $110 after the first year. That $110 then becomes $121 for the second year, $133 for the third year, and so on throughout the life of the loan. That is if you made 0 payments. I want to make note of this, that as credit cards often do, they don't compound that interest annually, they compound that interest monthly. So that 10%, and most credit cards sometimes push up towards 20%, that 20% is added every month. That is our concept in the value of money and compounding interest. Now that we know some longer ways for calculating present value, let's look at a couple shortcuts for calculating present values. Our first is perpetuities. Our second is annuities. We'll break these down at length in the next couple of slides. All right, first let's look at perpetuities. First, what is perpetuity? It's a single cash flow per year forever into the future. Think about it as perpetual, ongoing. So the concept of a perpetuity comes into play when valuing stock, because the price of a preferred share is equal to present value, of expected constant dividends that will be paid out each year forever into the future. So therefore, the present value of a perpetuity is equal to C, or that cash flow, divided by 1 plus that interest rate, and it's ongoing because remember, it's perpetual. This ultimately results in our present value is equal to our constant annual cash flow divided by the interest rate, or our rate of return. Here's our example for perpetuities. So let's assume that our perpetuity pays $100 per year at an annual interest rate of 8%. Therefore, the present value of that perpetuity is $1,250. If that interest rate fell, though, the present value of the perpetuity would look different, $1,666. Our next shortcut in considering value is annuities. Annuity is a constant stream of payments that is received for a fixed number of periods. These are common in the real world. We see them in examples of home mortgages, leases on vehicles, and pensions paid at retirement. We can utilize the following formula, and it should look similar to previous formula we just saw in perpetuities. Similar to that of the perpetuity formula, the annuity formula can be simplified to yield the following formula, and it is over a period of 2 years. It's our present value is equal to our constant cash flow with our brackets 1 minus smaller brackets 1 divided by 1 plus R times N bracket divided by R. So let's use an example of Nick Saban to help us understand this. Okay, so let's use Nick Saban as an example to help us understand annuities. In 2009, Saban signed a contract with Alabama that would pay him roughly, and we're rounding for our sake, $4 million in salary each year for 9 years. Many of us would look at that and go, $4 million times 9 years, his salary is $36 million. Not necessarily the case when we look at it in the concept of annuities. For our purposes, we're going to treat Saban's contract as that 9-year annuity. If the appropriate discount rate is 7%, we come to find out that the present value of Saban's contract in that when he signed in August of 2009, and assuming that discount rate, that value equaled $26 million. How did we get that? In this example, we involve the value of his salary, and then our present value factor of annuity is that 6.5. We're going to talk a little bit then in just a second of making sense of this. including risk and discount rates and or interest rates. I want you to think about something. If Nick Saban was promised roughly $4 million over that 9 years, why didn't he demand $36 million right up front? Because of the way our market works, there's risks. We take risks on things. There's risk on taking Nick Saban as your coach. There's a risk on putting money into this investment or so on. So how do we make sense of risk? So when we calculated the present value of future cash flow, we didn't discuss how to choose kind of this discount rate. The choice of discount rate is tied to the risk of the future cash flows, and risk is equal to the uncertainty. Higher risk means higher uncertainty. Lower risk means lower uncertainty. Okay, so in the previous example with Nick Saban, we calculated the cash flows without making any allowances for future uncertainty about whether Saban would actually receive that compensation. So let's just think about this. The jobs of college football coaches in football are tenuous at best. So to measure risk, we need to examine the behavior of returns on different types of financial assets. Okay, let's think about capital gains and losses then. That helps us put into perspective our risk. Capital gains are the gains in value of an investment. So let's just take our consideration of Nick Saban. If the University of Alabama considers Nick Saban an investment, did they gain value on their investment? You could argue that investment was $4 million a year. Did that University of Alabama gain anything on that investment? Also, I want to discuss here, however, dividends can be included in capital gains if the dividends are reinvested in additional shares of the same stock. Losses, those losses that are realized from the investment. If we look at our investment in Nick Saban from the University of Alabama, did the University of Alabama lose on their investment of $4 million a year in Nick Saban? I think for the most part, we could probably at this point in 2017 argue that the University of Alabama has made a good investment and they have gained tremendous because of their hiring of Nick Saban. Okay, so let's think long-term capital gains or losses. These are on investments that have matured for over 1 year and they result in capital gains or losses that have to be reported to the IRS for tax purposes. Those are long-term, over 1 year. Short-term capital gains or losses are those less than 1 year. Okay, rate of return. So how much money do we make off of? Or what is our rate of return? What kind of dividend did the University of Alabama yield in their investment of Nick Saban? What's the rate of return? So a couple ways. Dividend yield, and here's your formula, is consideration of kind of that dividend paid per share in a given year. In addition, it takes into consideration of what was paid divided by what the price of the stock was when it was initially purchased. We also have what is called a rate of return. So we have our stock price at the end of 1 year, and then we determine the price when the stock was initially purchased. Did we have a positive? Did we lose money or did we gain money? And then ultimately, what kind of return rate do we get? Our average rate of return, as this formula should look similar to what we've seen prior, is indicated here. Remember, the greater rate of return or dividend yield means that we've made a good or positive investment. So what kind of dividend did hiring Nick Saban yield? And what has been his rate of return? Some may say he has yielded a dividend of X, and many may say that his rate of return has been 3 or 4 or maybe 5 times the actual investment in him. Whew, okay, we finally have made it to the end of Module 3. We have done a tremendous amount of material in this module. Here are some questions for thought and ways to fact check yourself. Try to work through these and determine whether you understand the material or not.